Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about McKesson Corporation quarterly report. McKesson Corporation offers a diverse range of businesses and services across 4 segments: U.S. Pharmaceutical, Prescription Technology Solutions, RxTS, Medical Surgical Solutions, and International. The company's U.S. Pharmaceutical segment provides distribution of pharmaceutical drugs, as well as practice management, technology, clinical support, and business solutions to community-based oncology and specialty practices. It also offers consulting, outsourcing, technological, and other services to pharmacies, including financial, operational, and clinical solutions. In addition, the RxTS segment serves biopharma and life sciences partners by connecting patients, pharmacies, providers, pharmacy benefit managers, health plans, and biopharma companies to deliver medication access and affordability solutions. This includes medication access and affordability, prescription decision support, prescription price transparency, benefit insight, dispensing support, third-party logistics, and wholesale distribution support services. The Medical Surgical Solutions segment offers medical surgical supply distribution, logistics, biomedical maintenance, and other services to healthcare providers, including physician offices, surgery centers, nursing homes, post-acute care facilities, hospital reference labs, and home health care agencies. Lastly, the International segment delivers medicines, supplies, and information technology solutions to retail pharmacies, hospitals, long-term care centers, clinics, and institutions. It also provides logistics and distribution services for manufacturers. Overall, McKesson Corporation's diverse range of businesses and services enables it to provide comprehensive healthcare solutions across the United States and internationally. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what could cause McKesson Corp's stock price to increase significantly in the past year. McKesson Corp is one of the largest healthcare companies in the world, providing pharmaceutical and medical supply distribution services to hospitals, pharmacies, and other healthcare providers. In recent years, the company has faced significant challenges due to changes in the U.S. healthcare landscape, including the Affordable Care Act and the opioid crisis. However, despite these challenges, McKesson Corp's stock price has increased significantly over the past year. There are several factors that could have contributed to this increase. One possible reason is the company's efforts to adapt to the changing healthcare landscape. McKesson has been investing heavily in digital health technologies, including data analytics and artificial intelligence, which can help the company better serve its customers and improve patient outcomes. Additionally, the company has been expanding its services to include value-based care and population health management, which are becoming increasingly important in the U.S. healthcare system. Another possible reason for McKesson's stock price increase is the company's efforts to address the opioid crisis. In 2019, McKesson agreed to pay $184 million to settle allegations that it had failed to report suspicious orders of opioids from its customers. While this settlement was a significant blow to the company, it also marked an important step towards addressing the opioid crisis and improving the company's reputation. Finally, McKesson's stock price may have increased due to the overall strength of the U.S. healthcare market. The demand for pharmaceuticals and medical supplies is likely to continue growing in the coming years, driven by an aging population and advances in medical technology. As a leading provider of these services, McKesson Corp is well positioned to benefit from this trend. Overall, while there are many factors that could have contributed to McKesson Corp's stock price increase over the past year, it is likely that a combination of these factors has played a role. The company's efforts to adapt to the changing healthcare landscape, address the opioid crisis, and capitalize on the overall strength of the U.S. healthcare market have all likely contributed to its success. McKesson Corporation market capitalization of $118 billion is significantly larger than the average industry peer of roughly $6 billion. This shows that McKesson Corporation holds a significant advantage in their industry. McKesson Corporation trades at a higher price-to-earnings ratio of 27 times and a lower price-to-book ratio of -57.33 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 102% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted the company's financial performance. Revenue growth has been driven by several key factors, including a significant increase in revenue from North American pharmaceutical oncology and multispecialty prescription technology solutions, which grew by 38% in 2025 compared to 2024. The acquisition of Prism Vision and Core Ventures also contributed to revenue growth, as did market growth in the North American pharmaceutical segment. Additionally, the company experienced a 9% increase in sales to U.S. pharmacies and healthcare providers in the 3 months ended December 31, 2025. On the other hand, revenue decline has been attributed to a decrease in revenue from North American pharmaceutical oncology and multispecialty prescription technology solutions, which declined by 38% in 2025 compared to 2024. This was partially offset by market growth in the North American pharmaceutical segment, although branded to generic drug conversion had a negative impact on revenue. Other factors that have impacted revenue include the completed divestiture of Canadian Retail Disposal Group, which had a positive impact on revenue, while acquisitions completed during fiscal 2026 had a negative impact due to increased expenses. Opioid-related claims also had a negative impact on revenue. The company's net income and profit margins have undergone significant changes over the past year. In Q3 2025, net income increased by 35% compared to Q3 2024, reaching $1,250 million. This growth continued throughout the year, with a 49% increase in YTD 2025, reaching $3,244 million. The improvement in net income can be attributed to several factors. Firstly, operating income has increased, contributing to higher net income. Additionally, asset impairment charges and provision for bad debts have decreased, further boosting net income. On the other hand, cash provided by operating activities has decreased due to an increase in receivables and inventories. Profit margins have also shown improvement. The gross profit margin has remained relatively stable at 3.47% in Q3 2025, while the operating income margin has increased to 1.53%. This is a significant improvement from Q3 2024, where the operating income margin was 1.29%. The increase in net income attributable to non-controlling interests and lower net non-cash items have also contributed to the improvement in profit margins. Overall, the company's financial performance has shown a positive trend over the past year, with increasing net income and improving profit margins. The company's financial performance has shown a notable improvement in its ability to generate operating cash flow. The data reveals a substantial increase in net cash provided by operating activities, rising from -$1,663 million in 2024 to $2,734 million in 2025. This significant jump of +$4,397 million indicates a marked shift towards positive operating cash flow. Furthermore, the confirmation on page 19 reinforces this trend, solidifying the company's financial stability and growth prospects. The analysis of the company's financial data reveals a mixed picture regarding its debt level and interest expenses. On one hand, there are instances where the total debt increased by $903 million and $2 billion due to new debt issuance. However, these increases were offset by existing debt redemption and maturity, resulting in no significant change overall. Regarding interest expenses, while there were fluctuations between 2024 and 2025, including a decrease from $67 million to $63 million and an increase of $28 million. The net effect was also neutral. The company's financial situation appears stable, with no clear indication that its debt level or interest expenses have changed significantly overall. Management is optimistic about the company's outlook and strategy. In the short term, they anticipate significant charges related to technology service modernization and cost reduction efforts, totaling $650–$700 million by fiscal 2028. However, this is seen as a necessary step towards long-term sustainable growth. The company plans to achieve this growth through cost reduction efforts and rationalization within key segments, including corporate, medical surgical solutions, and North American pharmaceutical. Additionally, management is focusing on improving cancer and specialty care through its oncology and multispecialty segment. In terms of financial position, the company has a strong foundation with a $1 billion senior unsecured credit facility. Management believes that their strategy is working, as evidenced by increased net income and favorable timing of collections. Looking ahead, management anticipates continuing to pay quarterly cash dividends in the future and has sufficient capital resources to meet its financing needs. With a strong financial position and access to capital markets, the company is well equipped to execute its strategy and achieve long-term growth. The company has made significant moves through acquisitions and divestitures in recent years. In terms of acquisitions, the company has expanded its portfolio with the purchase of Prism Vision for $875 million on April 1, 2025, and Core Ventures for $2.5 billion on June 2, 2025. These strategic purchases are expected to boost the company's growth and competitiveness in the market. On the other hand, the company has also divested certain assets to optimize its operations and focus on core businesses. The Canadian Retail Disposal Group was sold at fair value less costs to sell in fiscal 2024, with the divestiture being completed in fiscal 2025. These transactions demonstrate the company's commitment to strategic growth and optimization of its portfolio. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts to its investors. For instance, in 2025, it distributed $280 million, while in 2024, it paid out $254 million. In addition to dividend payments, the company has also been actively buying back shares from the market. The net amount spent on share buybacks was $2,079 million in 2025 and $2,846 million in 2024. Furthermore, the company's financial reports indicate that it spent a total of $2.1 billion on share buybacks in 2025. These actions demonstrate the company's commitment to returning value to its shareholders through both dividend payments and strategic share repurchases. Concerns about inventory buildup and supply chain disruption have been raised in the company's financial reports. One notable instance is the decrease in inventories by $4,098 million for the 9 months ended December 31, 2025, page 19. This significant reduction suggests that the company may be experiencing issues with managing its stock levels. Furthermore, the company incurred a LIFO charge of $89 million in 2024 due to lower expected brand inflation and restructuring charges related to impairment of inventories within cost of sales, page 69. Additionally, inventory impairments totaling $63 million were recorded for the 9 months ended December 31, 2024, page 71. The company's working capital also decreased due to an increase in drafts and accounts payable, but was partially offset by an increase in inventories, net, page 84. This indicates that while the company is managing its cash flow effectively, it still faces challenges with inventory management. The higher inventory requirements during the period compared to the prior year, $1 billion decrease in cash, also raises concerns about supply chain efficiency and potential disruptions, page 77. Overall, these instances suggest that the company may be experiencing difficulties with inventory buildup and supply chain disruption, which could have significant implications for its operations and financial performance. That concludes the financial summary for McKesson Corporation. Feel free to comment below, and I will be happy to answer them when possible.